Hello, investors. How are you doing? Hopefully, you're doing great. And let's do this amazing stock, which is the Walmart. I think honestly speaking, my income is going to Walmart as well because buying a lot of groceries and all those stuffs from there. And I thought, okay, why? Let's see how the finance and fundamentals are doing on this one, and it's a good buy or not, right? So I don't think there's any brainer, but our job as rational investors or to see if we can make any sense rather than just go from the sentiment perspective, right? Because we want to see from the long term perspective. Okay, so given that, let's continue. So the company is Walmart, is a very big global brand, need no introductions. It's in everywhere. It's when I went to the 10K, it's from India, China, US, Canada for sure, but in other, and we see pretty high level, the region level where it is, but it's huge present. It's still a brick and mortar, but they also have online presence. And during coronavirus time, I did a lot of online shopping as well for sure, and that's why I know. Okay, okay. So let's get started. So this is the very high level why key things. What I find is a dividend stocks. It gives 1.89. It's not too bad. This is the if you invest in 5 years, so the 5 year annual growth will give you 5.63%, right? And given that whether the economic is good or bad, how bad the economic can be, right? So it's always in business. So even in the time of coronavirus, we see these are the key business which is always running. They sell necessity, low price, and people go in. And the global brand, right? People, and honestly, yeah. So I think no, they don't. And the one of the best thing which I also like about it. So these are the key areas I think I plotted upfront is low beta. Low beta means is a low risk in terms of the market, right? So whether the market is flat or goes, companies still have a doesn't much correlate with that. So think from that perspective. Okay, so it's a low risk, so that's pretty good. Okay, so before I go further, and in this video I will use the two discount model to come up with the fair intrinsic value of the stock, free cash flow for sure, and then the dividend discount model as well, because it does give the dividends. And then we'll see from the different financial perspective how the company is, where the company stands, and try to make opinion at the end. And some other, right, if it has any share repurchase and all, it really helps, right, to boost the shares. So that's pretty much it. If you're excited, stay with me, and I hope you will like this video for sure, and give a thumbs up. And if you're new to the channel, just give my introduction to you. Myself, Pramod Kumar. I am a CFA charter holder, and this is my website, riseanalytics.ca. Most in my channel, I did the stock review on the fundamental and the long-term investor perspective, and a lot of ETFs and the technology and stocks. You can just search the channel, and if you want me to cover, usually I cover take from the comments what the YouTubers investors wants me to cover and what's in my list, and then try to cover that as well. Okay, so that's enough about me and the channel. So let's get started our journey. Okay, so let's go straight to the financial with no surprise. And I know you cannot see me, hopefully the other, yeah. So let me make myself hide, go away. Okay, now it's better. Okay, so this is the Walmart. So Walmart total revenue, this is the latest quarterly revenue on the Q1 which they have published, right? So you see it, despite of the coronavirus, the company revenue increased, and it's not small amount, right? This is in million, is 10 billion, $0.6 billion, and this is 8.6% increase in the revenue. So that's a huge. Net sales is increased 8.7%. That's huge in terms of the revenue. The membership and income 9.5. And I was watching his the CEO interview as well. So it seems like they're planning to introduce more membership plans, right? So that's good. Something like similar to Costco, hopefully. So they have that consistent member, and once you have the membership, it stick to it, and that's pretty good, right? That's extra additional income, so they might get some good benefits. So I'm looking into that as well. So this means the company is thinking, and it's also maybe to put here that recently 1 or 2 years ago, I think they also bought the company which gave the solid online presence, which really pays off now in the times of the coronavirus, right? And still they're improving, doing the best thing. Operating income, okay, let's continue. It is 5.6, and this is a very low margin company, right? But I'm surprised that they can still able to make that much income, right? And people, honestly, they do anything to the suppliers to come onto the Walmart because it's huge, and they dictate, honestly, they dictate based on their volume, right? They goes on the volume, okay, and which it shows here in terms of their number, right? So numbers is huge and is a volume number game. Okay, so the EPS side is a 5.3% increase from just on the quarterly basis, and adjusted EPS is 4.4. So that's pretty good, right? So right up front, if I see from the gross profit rate percentage change perspective, it's 23.7% gross profit, and then effective tax rate is 24. Return on asset is 6.6%, and return on investment capital is 13.4, which is reduced 1.10. When you said 110 bips, it means 1.10% reduced, little bit reduced, but it's still good. Okay, so free cash flow, look at this, right? This is insane, right? The free cash flow, when everybody is crunching for cash, and when I remember a few weeks ago, the Carnival cruise and other cruise, right, and all other airlines and these other kind of companies, that they are worried on the cash, right? But this is a cash machine, right? So this, look at this, the operating cash flow jumps almost double, right? And there, right, and the capital expenditure even they increase, but still the operating free cash flow is huge, right? So that's just pretty good. The dividend increased the dividend to 0.6%, which is in millions, so $1.5 billion dividend, and they did a share repurchase as well, and I'll put more focus here. So that's a lot of information, different format, but all condensed, try to give you the more and more data to analyze in a short period of time, and it's good as well, right? So this thing, I like it. The share repurchase, they did have in 20 billion of share repurchase. It was approved into 2017, right? And now as of this year, January 31st, they also authorized 5.7 billion of share purchase, and they need to do, right, which is still remaining. So pretty good. If nobody will, they do nothing, even they can go and buy that much, and that's not a small amount, right? That's the US dollars, $5.7 billion we are talking about. So that's a very good sign when the company has a lot of cash. Okay, now as an international, so this is, I'm not talking about here on so far, but we have seen it's on the US market, right? And they are also on the international. So Walmax is basically in Mexico and Central America. If we see their net sale, which is right here, so 11% as compared to the revenue, and then China is 13.7 and blah, right? And Asia. So look at there, right? What I'm getting here is, like, look at the global presence, right? In Canada, for sure, I definitely see here the stores are increasing and Canadian population is increasing, so it's pretty good. And in UK, it seems like decrease in terms of their gross profit margin and operating margin, but in operating income is increased in Mexico and Central America, and Canada is increased. In China is decreased, maybe because of total shutdown there, right? Okay, so now we'll go a little bit more deeper to see, and then I'll go to the models, right? So I just want to show you some the plotting here. So this is the revenue and the net income. The reason why I have put it here, if we can see here from 2012 and on the 2 years onward basis, and these are in billions, right? So this $523 billion of in terms of the revenue they are collecting, right? So the net income, this is a very thin, and the bottom line is it looks thin, but it's not thin, right? You can see this is $14.88 billion, the revenue. That's a huge, but the margin are less, right? So they are playing on volumes and less margin, and which clearly seen here, right? That's pretty much, even the margin of 1%, right, or less, it's huge. The number of shares outstanding. So this is an interesting plot, right? So it seems like the company keep reducing the number of outstanding shares. If there are less share outside, the price for sure will go up, right? So that's the way of the company. And the 2017, which is just 3 years ago, they bought $20 billion of shares, right, within certain period of time, and now they allocate again 5.8 billion. So this is a another way of company not only giving in terms of the dividend, but also boosting the in terms of the price, right, by buying the share. So that's pretty good, and which is clearly seen here. I hardly see like this kind of a chart in any other stocks, honestly. Okay, so dividend per share is also increasing, right? So you can see here from 2012 it was around 0.30 cents, and now it's 54 cents. So it's keep consistently going up, so which is again pretty good. So both ways we are getting in terms of the price appreciations because of the dividend buyback, and company does well, that's another thing, and second thing for sure, dividends. So that's pretty cool. Okay, let's go to the model now. Okay, so this is the first I'm showing the Walmart dividend discount model, and then I'll go to the free cash flow model and two model, and then come up with my price. So this is the 5-year growth I'm taking at 19. The price, the dividend per share is $2.16, and I when I did the short-term growth, the trends, I got the 4.16 percentage, and then I slowly reducing it up rather than just taking it and jumping is more like a kind of a model, and just the continuously growth on the 2% basis then, right? And when I did this, and the required return is 3.78%, I'm taking. The reason I'm taking this is because the company has very low beta, so that's one of the reason I got this, and the debt is also at very low rate. So when I did both, I got very, but actually in this one the kappa model, so I got the low rate from that. So that's pretty much it. So when I plugged the number, did the growth and discount, I got $130.34. Okay, so next let's go to the Walmart. Okay, here basically in the free cash flow, which is $14.55 billion, and then I'm going to the 10 years, right? So in this period, I take again the same discount rate, but here the growth rate, I take the short term for 5.63, and the long term I'm taking again the 2%, right? And the terminal value, okay, so 15. So when I plot this, did the number, so got it $136.90, right? Around $385 billion companies I got as a value. So now when I compare with both the model, right? So with the, when I take the pricing, take the 50% from free cash flow, and other model, I got $133, which is approximately the similar what the price is in the market right now. Don't get distracted that why I'm taking this lower discount rate. So basically this is if the company has enough power and enough liquidity, think from that perspective that they can generate a lot of cash and they have a lot less debt. So the debt will come at the lower rate. And also if the company is not risky, because if the company is more risky, then we'll have the higher required return, right? But if the company is less risky, right, and it can able to sustain, then the rate is lower, right? So we cannot have one rate for all the companies. So that's why we have the models. We inject into the model and then we put it here. So hopefully in the very diluted terms, I explain why it is, right? And okay, so that's what pretty much. So at the moment, let me go to the slide back, right? Okay, so we have seen both models, and if I compare with this, and if we take I was a little bit conservative when I even put my numbers into the model, and so that's what the price is coming, and the average price you can think of, and that's pretty much what I am seeing in the market. So now the stock is fairly value, right? But one of the reasons, actually, if I go back so this is a very good global brand company which printing the money, right? So I think it's pretty good to have it, this kind of a company, and definitely I have some shares on that one, and if I got a chance, I'll got some liquidity, I'll buy some more to it, right? It's a more stable, it's not like those kind of high tech, it's growing, making a good decisions, and these are one of our necessities as well, right? Think so that's what my opinion on it. Let me know what you think about it. Please put in the comment that you like this. If you like this, give a thumbs up, so Google algorithm will pick it up. And if you want me to cover any other video, or you want me to check any other video on my channel, please comment for the new videos, and go for other videos on my channels if you want to see some other which I've already have covered. Okay, so that's it from me for this video. Thanks for watching, and see you soon in the next video. Bye for now.